Amazon is up 5% today.
But if you think that Move is about e-commerce, you're looking at the wrong company. Amazon stopped being a retailer years ago. What you're actually holding, or considering holding, is the dominant cloud infrastructure company on Earth, wrapped inside a logistics network, wrapped inside an advertising business, wrapped inside a consumer brand. The retail operation is basically the marketing department. I ran Amazon through 15 institutional research frameworks, the same analytical tools used by professional analysts. What came back was one of the clearest pictures of durable competitive advantage I've seen on any large-cap stock. Let's get into it. Here's the first thing you need to understand about Amazon. The business model is a deliberate misdirection. The retail operation, the part everyone sees, runs at razor-thin margins by design. Amazon has always used retail as a customer acquisition and data flywheel, not as a profit center. Every Prime member who buys household goods is subsidizing the real businesses: AWS, advertising, and third-party marketplace services. AWS, Amazon Web Services, is the engine. It generates operating margins in the 35 to 40% range and accounts for the majority of Amazon's total operating income, despite being a fraction of total revenue. When Amazon reports earnings, AWS is the only number that actually matters to the long-term thesis. The advertising business is the hidden gem. Amazon now runs the third largest digital advertising platform in the world, behind only Google and Meta. And it has something neither of them has: purchase intent data. When someone searches on Amazon, they're not browsing, they're buying. That makes Amazon's ad inventory uniquely valuable, and it's growing faster than the core retail business. Third-party marketplace services, fulfillment fees, seller tools, logistics add another high-margin revenue layer that most investors undercount. What you have is a portfolio of businesses, most of which, individually, would be worth hundreds of billions of dollars. They happen to share a brand and an infrastructure. Now let's talk about where Amazon actually wins, and why the moat is one of the most durable in large-cap tech. AWS has the deepest competitive moat of any business Amazon operates. Switching costs are extreme. Enterprise customers build entire technology stacks on AWS infrastructure. Databases, machine learning pipelines, compute clusters, security architecture. Moving off AWS is a multi-year project that most CIOs will never voluntarily undertake. That creates pricing power that compounds over time. The Prime ecosystem is the consumer-side moat. Prime members spend roughly twice what non-Prime members spend on Amazon. The flywheel is simple. More Prime members means more demand, which means better supplier terms, which means lower prices, which means more Prime members. After 20 years, that flywheel is spinning fast enough that it's essentially self-sustaining in North America. The logistics network is the third moat, and the most underappreciated. Amazon has built a last-mile delivery capability that rivals UPS and FedEx at lower cost with better data. That infrastructure took decades and hundreds of billions of dollars to build. No startup can replicate it. No incumbent wants to fund the attempt. The honest moat verdict: AWS switching costs are exceptional. Prime loyalty is real. Logistics infrastructure is a genuine structural barrier. These three together make Amazon one of the highest conviction moat stories in the market. Let's talk valuation. Amazon traditionally trades at a premium to the market, sometimes a significant one, because investors are paying for optionality. The AWS growth curve, advertising expansion, and whatever Bezos or Jassy decides to build next. Running a discounted cash flow across three scenarios tells an interesting story. Base case, AWS growing at 18 to 20% annually, advertising continuing its current trajectory, retail operating margins gradually expanding as the business matures, points to fair value in the $220 to $260 range. Bull case, AWS re-accelerates on AI infrastructure demand, advertising becomes a $100 billion business, and operating margins expand faster than expected, pushes the model above $350. Bear case, cloud spending slows materially, Microsoft Azure takes meaningful share, and the retail business faces sustained margin pressure from competition. Floors out in the $140 to $160 range. At $286 today, the market is pricing in something between the base and bull case. That's not crazy given the AI infrastructure tailwind, but it does mean the valuation is not cheap. You're paying for execution. The most fragile assumption in the bull case is AI monetization timing. Amazon is spending aggressively on AI infrastructure, custom chips, and large language models. The costs are visible now. The incremental revenue, above and beyond the existing cloud growth, is still being proven. Here's what I think most investors miss about Amazon in 2026. The AI story for Amazon is not about Amazon building a competitor to ChatGPT. It's about AWS being the infrastructure layer that everyone else's AI runs on. Every company building an AI product needs compute. They need storage. They need a place to train models and serve inference. The overwhelming majority of that workload runs on cloud infrastructure, and AWS, Azure, and Google Cloud divide that market between them. Amazon is not trying to win the AI model race. It's trying to own the track the race is run on. Bedrock, Amazon's managed AI service, lets enterprises access foundation models from Anthropic, Meta, Mistral, and others through AWS without managing the underlying infrastructure. That's a business that grows every time anyone deploys an AI application, regardless of which model they choose. The competitive risk is real. Microsoft's Azure and OpenAI partnership is a genuine threat, and Google Cloud has strong AI momentum. But AWS's installed base, switching costs, and enterprise relationships give it a structural advantage that isn't going away in the next 2 to 3 years. Every framework pointed to the same thing to watch: AWS revenue growth rate and operating margin expansion in the back half of 2026. AWS has been re-accelerating after a period of customer cost optimization. If that re-acceleration continues, and early signals from Q2 suggest it is, the bull case becomes significantly more defensible. Operating margins expanding toward 40% would confirm that AI workloads are accretive to the business, not just volume adding. The retail business reaching consistent double-digit operating margins in North America would be a secondary catalyst. It would demonstrate that the decade-long investment in logistics infrastructure is finally converting to structural profitability. Watch AWS growth. Watch retail margins. Everything else is noise. This analysis was produced using Norris AI AlphaLens, 15 institutional research frameworks on Amazon, synthesized in plain English by Claude AI. You can run the same analysis on any US stock, all 15 frameworks available right now. The link is in the description. Use code Reddit-free-trial to try it free, no credit card required. If you found this useful, subscribe. We publish a new institutional analysis every Friday. I'll see you next week.